All right, everyone. We're very happy to have Mr. Fahad Al-Rashid with us today from Vision Ventures. Fahad, I'll let you introduce yourself and hand it over to you. Thank you very much.
Thank you so much, Hans. It's a pleasure to be here. Hi, everyone. My name is Fahad Al-Rashid. I'm part of Vision Ventures. I hope you're all doing well. I will be your speaker today for this session. Before I start, I just want to give a big thank you to MCIT and Plug and Play for putting up this session together and putting up such an impressive group of entrepreneurs. I've had the chance to go through all of your company profiles, and I must say I'm really impressed by your experiences and your products. It's a pleasure to have this session with you, and I'm looking forward to learning more about your businesses in the future once we meet, inshallah, physically. I know it's Ramadan, it's very tough to have this session physically, so it was more suitable to have it as an online session. So with that, I mean, we will cover today a lot of topics about fundraising. I think let's just get started. I would love to start by giving you the agenda of today's meeting. I will start by giving you a quick overview about myself and about Vision Ventures, who we are, what's our investment strategy, what's the team, and the timeline and the origins of Vision Ventures and its establishment. Then I'll move to the investment thesis of Vision Ventures, and I will shed light on key highlights of investment criteria and the VC asset class. And I'll move to walk you through our portfolio companies, and I'll give you like a breakdown of our companies and the sectors that we invest in. And then I'll talk about like some fundraising insights, expect things like trends, tips about fundraising, especially during this, let's say, time of the market. Maybe also mentioning some myths about fundraising, and we will work together to try to debunk them. The first thing first, as I mentioned, my name is Fahad Al-Rashid. I'm part of Vision Ventures investment team. I have a degree in finance from Principal University. I started my career as a founding member of a startup. It's a fintech startup called Tamawal, which basically is a marketplace for financial products. Think of it as like Jahez or Hunger Station for loans and mortgages. We were backed by 500 startups. We closed a seed round of $1.1 million in funding. I was the chief operation officer at that time. But when COVID happened, things were a little bit unclear for me. During that time, there was no, let's say, clear regulatory framework. There was no open banking that governed our launch in the market. So I chose to go to investment banking, a more, let's say, stable and certain job. So I joined HSBC as investment banking analyst. I spent there some time. I worked on several IPO and M&A deals. I had the privilege to work on the first IPO of tech startup in Saudi Arabia, which was Jahez. I remember during my time in HSBC, I was witnessing the booming of the startup ecosystem again, especially after COVID. And I started to have some cravings about the space, and I wanted to get back to entrepreneurship. But this time I decided to come back as an investor. So I decided to choose something that combines both investments and entrepreneurship. Hence I chose venture capital. And I only applied to one single firm, which was Vision Ventures. And when I speak about Vision Ventures, I think you will know why I applied only to one firm. I spent with Vision Ventures almost a year and a half now. And I've been in both ends of the table as a startup founder and also as an investor. And I would like today to share with you some of my experience in that regard. By entrepreneurs for entrepreneurs. This is our slogan, Vision Ventures slogan. Every single member of Vision Ventures is entrepreneur. The management, the investment team, and the support team. Every single one of them either had started a company at some point of their life or was a part of a company. And so if we talk about the overview of Vision Ventures, I could summarize it in 3 sentences. We are a Saudi venture capital that invests in early stage startups targeting MENA region. And when I say early stage startups, I mean pre-seed, seed, Series A, and sometimes we do Series B. And as I mentioned, we are sector agnostic, meaning that we don't have certain verticals or specific sectors that we invest in. We invest in a variety of sectors, and I'll show you in a minute our breakdown of our investments. And as you can see here, there's numbers of our investments. We have over 50 plus portfolio companies and over 150 investments. We have more than 4,000 jobs created by our portfolio companies. And in 2021, we have $4 billion. Our portfolio companies generated $4 billion in 2021 alone. We do 21 deals approximately per year. So that's a brief about vision and about our fund details. This is a quick snapshot about our team. We have Mr. Qais Al Isa, our CEO and founding partner, Mr. Haytham Abu Aisha, our founding partner and investment manager, Mr. Mohammed Al Ahmed, our CFO, and Mr. Ghai Sharad, our investment manager. And down in the bottom of the page, bottom half, you can see the investment team and the support team. And now I'll talk to you about the origins of Vision Venture, which is a very interesting part for me. So Vision Ventures was established in 2016, as you can see here. However, its origins story dates back to way before than that. It dates back to 1989. As you can see here, the company, I mean, two young guys that I just showed you, Mr. Haytham and Mr. Qais, two young guys decided to start a tech startup while they were in college. And can you imagine how difficult it was to start a tech startup back in 1989? There was no Google, no internet, no Slack, no WhatsApp, no Wi-Fi, not even like PowerPoint to pitch to your investors. So the bulletin, so they started this bulletin board service, which I really have no clue what is it about, something very old. But from what I heard from our partners, basically it's like an internal server that facilitates what do you call it, information exchange of information in local network. So think of it as a small or a mini version of internet. That was in 1989, and then in 1994 they have done. They became a real internet service provider, and they became the first internet service provider company to offer internet Saudi Arabia to offer internet in Saudi Arabia. And then moving to 1998, they received their internet service provider license. And after that, in 2004, they started their fundraising for their first round. And again, can you imagine how difficult it was to fundraise in 2004? There was no safe letters, no plug and play at that time, no DocuSign, nothing at all. But they managed to fundraise from three well-known family offices, and also they pivoted and changed their model to B2B from B2C to B2B, because the B2C was very, let's say, the competition was very rigorous at that time. So they changed to B2B and they started to provide, let's say, like cloud service, hosting, cybersecurity, and connectivity services. In 2009, things dramatically changed. They got acquired by Belgacom, which is a European giant ISP company. It's a multi-billion-dollar ISP company. The investors who entered at 2004 got 7x on their investment. Keep in mind that this happened literally in the midst of 2008 financial crisis, which is a very great return. And in 2014, management reacquired the shares because Belgacom strategy regarding the region has changed. And in 2016, after more than 20 years developing tech products inside of their company, Sahara, and after fundraising multiple rounds and after founding several tech startups, they decided finally, the management, to start a VC to invest in the future. And they started Vision Ventures. So that's the story behind Vision Ventures and how it all started. And now I'll tell you what happened since the establishment of Vision Ventures. So in Vision Venture in 2017, we became the most active new VC in the MENA region. We were still part of SaharaNet, the company that the managers established in the 90s. But in 2018, they changed that and they became a separate entity where we started raising funds from other investors, who we call limited partners. In 2019, we had the first closing of the fund. And in 2020, we got investments from PIF, Jada, Fund of Funds, SVC, and SVC. In 2021, we had 3 exits, a strong portfolio performance, and we fully closed all the commitments. And in 2023, we aspire to positively impact the lives of people in MENA using technology. So that's a quick story about Vision Ventures and its origin, even before the establishment of Vision Ventures. And now let's talk about Vision Ventures investment thesis. I think it's a very important segment of this presentation. So as I mentioned in the beginning, we are a sector agnostic firm. And being a sector agnostic firm in such an emerging market in Saudi Arabia or in MENA region is the most optimal path. However, as market mature, we see in other markets, there will be emergence of vertical specific VC firms. We invested in several sectors, from fintech to logistics, to e-commerce. I'll show you the breakdown of those sectors later on this presentation. However, we tend to have some preferences of certain sectors over others, like the one you see in front of you. We have e-commerce, or as we call it, future commerce, not the typical e-commerce. And we have fintech and SaaS and cybersecurity. When we talk about e-commerce, as I mentioned, we mean future commerce or second generation e-commerce. Things like infrastructure for e-commerces, e-commerce builders, logistics solution for e-commerces, warehousing, etc. And for fintech, as you know, it's the most loved space for VCs because of the combination of large market potential and scalability and disruption, let's say, in the space. And we have also the SaaS. SaaS is well known it's actually the most loved by VC internationally because of the recurring revenue and the low overhead costs, and also the ability to leverage cloud in such, as we now know, the cloud became more cheap as computing power get better and better. We have also cybersecurity management comes from a cybersecurity and cloud and tech background, and they touch and they know the need of cybersecurity solution, innovative solution in the space. And we know that there's a huge market opportunity in this space. And there is, let's say, also a regulatory compliance by the region to have solid cybersecurity infrastructure solutions. Hence, that's why we also focus on this sector. If we go to the bottom half of this page, we look at things we look at. With every deal that comes to us, there are multiple factors that we use to analyze this deal and to do the screening required for this deal to see if it fits our scope or not. There are many, many things, but these things that you see in front of you are the most important things. It's not in order, but if I would order them personally, depends on the stage of the company. I would say in early stage, pre-seed round, let's say, or seed round, we would have more emphasis on the team in the beginning and also the market and the scalability of the company, meaning the business model, innovation, or the innovation of the technology itself. And as you progress in the stages, there will be some metrics more favored than others, and I will touch base upon that later. But let me just shed more lights on 3 of the main important things here. Let's say, for example, growth and scalability. I mean, startups that have potential for growth and scalability are very attractive for VCs. And such startups should have large addressable market size and also sustainable. This is the most important part, sustainable competitive advantages to capture this market share. And the second point, I mean, I could pick and choose anyone, but let's talk about innovation and disruption. We see that startups that bring new disruptive ideas to the market, whether it is like through novelty of their business model or novelty of their technology, they are very attractive for this asset class, in particular the VC. And these startups often have the potential to create new markets or disrupt existing one. And that basically like sums the second point. Maybe one of the most important parts of an early stage startup is the team. And I mean, I could spend hours talking about the team, but let me just give you like a brief, let's say, points that we think that is important for evaluating a company and evaluating its team. I think one of the most important things is their experience and how relevant it is to the industry that they are in, and also their complementary skills. It's very essential to have co-founders or management team with variety of skills that complement each other. This will give synergies and will help the company scale much better. And also there's the entrepreneurship or entrepreneurial mindset that the company or the team has. We see that serial entrepreneurs tend to have more success than first-time entrepreneurs. That's why it's essential to have it's not a deal breaker, but if you have entrepreneurship experience, that will be a very extra point for you. And there are many other things, but if I could summarize them, I would say these are the most important things. And there's one more thing, which is the commitment of the team, full-time commitment of the management and the co-founders. During the investment or after the investment, it should have be found before investing in such a company. And as you can see here, the stages we invest in, as I mentioned, pre-seed, seed, Series A, and Series B. Sometimes we do it holistically. I mentioned the previous stage that every stage has certain metrics and certain, let's say, milestones. And I'm sure you know all of this, but it's remarkable to just shed more lights on them. So for seed stage, the main focus should be creating the MVP, testing the product, creating the team, and to eliminate the execution risk. This is the biggest milestone and the most importance of this stage of funding. And then we have the Series A, which is PMF, which stands for product market fit. You have to prove the market needs your product. Actually, you have to find the right clients with the right price, which means you could now say that you eliminated the market risk. And Series B and Series C, here we talk about expansion, scaling up, eliminating the scale risk, and eliminating the expansion and growing risk. Now let's move to key highlights about our investment pieces. I will talk first about the process that we do and typically other VCs do. And we'll talk about some like key highlights about our investments. So in VC, we tend to have a systematic approach in choosing our investment opportunities. We start by sourcing data, then analysis, then we do negotiation with the company. And after that, we get approval from our investment committee. We structure the deal, and then the company turns to a portfolio company where we could manage this company. I don't want to spend a lot of time here in this process. I will just try to, because I want to allocate the last portion of the meeting for Q&A. So sourcing could come in a variety of ways. It could come from cold emails, it could come from our network, stakeholders, other investors in the space. Our portfolio companies could bring us a deal flow. There are many ways that we could get deal flow from our website, from our social media channels, and also from testing the products ourselves. There are many companies that we invested in. We found them by testing their product organically, like having a food get delivered to your house. You were hungry, and then you wanted to download an app, and then you got really intrigued by this app, and then we invested in it the other day. So that's also a great source of deal flow. The analysis part, where we screen the deal and we have meeting first meeting with the management team, where we get to know more about the company, and also we request some data room information like forecasts, some projections, things related to the technical setup of the company, the use of proceeds, and some, let's say, legal documents where we could analyze the deal further. But it's for early stage, it's considerably a high level, let's say, analysis. And then we move to the negotiation and agreeing on the terms and the price and the deal terms. And after that, after we get the approval, we structure the deal and we do the due diligence. The DD comes before and after. And after that, we we start to have it, we start providing, it becomes a portfolio company, and we start managing this company and helping it grow through many added value services that we provide, which I will talk about later in this presentation. Some key highlights about our fund and also about other funds. Let's say, so a number of deals, we get approximately 1,500 deals annually, and we only invest in 15 to 20, which means 1-2%. It's a very small percentage of deals that we invest in, and this is the case for all VCs in the region or outside. Investment stages, as I mentioned, pre-seed, seed, Series A, and we also do follow-on investments. Actually, we do follow-on investments more than first checks because we double down on our winners, and we tend to lead their investment round further on if they prove that they are good performers. The investment size ranges between $250 to $1 million for pre-seed. That's for a first check, and it could increase with follow-on investments. For Series A, Series B, $250 to $3 million. But I think that our sweet spot for early stages is between $750,000 to $1.5 million. And the information below is not very important. We take minority interest in startups, something between 5 to 10, and most VCs do that thing. It's a normal standard. And we add value in a variety of ways, whether it is through advisory sessions, whether it is through connections to other key stakeholders in the space, whether it are they investors or partnerships or other portfolio companies where you could integrate and synergize with them. We do PR support, and also as founders or as management that has tech background as Vision Ventures management, we always tend to have our hands dirty and help the startup in their experience, whether it is through the technical expertise and helping them in their technical tech stack if they think that they need that thing, or also in other things like expansion and growth related activities. Let me show you now our portfolio. Let me give you like a quick walkthrough of our portfolio. This is our blood portfolio. This is just the first slide. There's more slides. Yes. We have 60% of our portfolio consists of fintech startups. You can see Rain, it's a cryptocurrency Web3 exchange. We were the first backer of Rain. That was back in late 2018. We have Nearpay, which is a disruptive sub-POS company. We have Raqamiyya, debt crowdfunding company, Spare, open banking platform. We have an infrastructure for Sukuk, and Sarwan Investment and Personal Finance Solution, and Tamara, Buy Now Pay Later. You can see there's a star next to Tamara, which means that we exited Tamara. You can see the food tech, we have Chefs, which we exited already like almost 5 months ago. Vision Ventures led their first and only investment round, and Mr. Qais Al Isa, our managing partner and founder, our CEO and founder, was the chairman of the Chefs, and it was one of the biggest startup to startup acquisition in the whole region. We have Kalu. Kalu is also we were the first backers of Kalu, and we invested in them multiple times in their investment rounds. Actually, matter of fact, Kalu founder, Ahmed, he used to work with Vision at some point of his life. Such an amazing and great founder. We have also Foodex, Hasil, Munch On, and POS Rocket, where we exited as well. Future Commerce, we have Sella. Sella was one of our first investments. That was way back in the day. We invested in Sella several times. I'm sure you all know Sella. It's the giant e-commerce builder. Liwa, Sayyara, Cartlow, and in the next segment we have Gather In and 360 Views. 360 Views is a social immersive app which leverages the AR and VR technology. And we invested in it way back in the day in 2000, I think in 18 or before that, before Web3 became a mainstream thing. We have media, marketing, logistics, edtech, and health tech. HR and cybersecurity. As I mentioned, cybersecurity is one of the targeted sectors that we have. Agri-tech and profit. So now let's move to some insights regarding fundraising. Starting with fundraising trends, we're seeing some valuation uh, valuation are facing downward pressure starting from 2022 till now. We're seeing this trend happening. I will talk in depth about why is this thing happening. Mainly, it's due to political tension, inflation, interest rate hikes. Uh, I mean, I would not say that the valuation now are considered low, but I mean, it's more realistic and it got back to its normal levels. And also another key trend that is happening, investors' due diligence is more thorough and strict than before. First, the round sizes have been reduced massively. We don't see nowadays a seed stage company raising $5 million. Last thing is in the past. And second, investors are becoming more and more selective. And there's a flight over quality than just the price of the company. And finally, investment now have to have, whether it is in Series A, Series B, or Pre-A, has to have revenues and revenue growth and a strong team. And all of these market fundamentals are now back to this to be in place. We all know how were the evaluation mania that were in 2020, 2020 and 2021, and things are now correcting and getting accepted. And now I'll talk about fundraising tips. I think these are, let's say, obvious things for you, and I'm sure you know all of these things. But I think I forgot something, which is, startups shift to sustainable growth. Yeah, this is a very important thing that we are seeing right now. In the past, startups used to focus on growing no matter what the cost, but now they are focusing on sustainable growth because of the market conditions. I mean, investment rounds are taking much longer, which results in fewer raises and less cash. This results in having the startups focusing on more sustainable growth, generating more revenue. And this is a top priority now for investors and startups more than ever. And we are seeing also new ways of fundraising. Other than VC investment, dilutive capital, we're seeing now emergence of venture debt. We're seeing crowdfunding right now are getting licensed, which means more opportunity to get crowdfunded or getting a venture debt. We are seeing the emergence of revenue-based financing. And I'm sure you all know the initial coin offering and ICO. Since some of you are Web3 companies, we're seeing also some movement in ICOs relative to 2020. Sukuk is now becoming a type of funding for, let's say, growth stage companies. We have also, as well, banks started to participate in fundraising. They started to provide banking and credit facilities to startups, especially fintech startups with relevant and adjacent markets. And other than fundraising, there are also new players in the market, new forms of players like venture builders, corporate venture builders. There are also rise of syndicate groups, angel groups are forming now more than ever. Family offices are entering the scene. So these are like fundraising trends. If I could give you like a summary, so the valuation are coming to realistic levels, slower fundraising, startups are struggling to achieve the valuation that they used to do in 2022, 2021. But nowadays with the new fundraising ways and startups shifting to more sustainable growth, they will be able to raise funds, let's say, in a much efficient way. Let's now talk about fundraising tips. And this is, I promise, this will be the slide before the last one. Then we will have Q&A. So I think these are all self-explanatory. You have to build relationships. You have to know your numbers. You have to create a compelling pitch. You have to leverage the social media of your company. And building a relationship is, for me, building a relationship with investors and key stakeholders. But let's focus on investors right now. think one of the most important fundraising tips is building a relationship with investor. I mean, take the time to research and understand their investment preferences, their values, their portfolio. Um, Try to attend events and conferences to meet them and make good impression. And remember that fundraising is a long-term process, and building relationships takes time. Um, Maybe know your numbers. It's very obvious. I mean, investors want to see you having a solid understanding of your business and its financials. Be prepared to provide, I mean, detailed financial, let's say, projections about revenue, about expenses, and cash flow, and know your metrics, and know that every business model has its own metric. Every stage of the company has its own also important metrics, and use it to compare also yourself to other industry, let's say, or I mean other benchmark yourself to others. And the more you know your numbers, the more confident your investors will be, especially at this market downturn time. Create a compelling pitch. I can't stress this point. I mean, your pitch is the first impression of your investors. It is crucial to create a compelling story. Uh, uh, I mean, you have to explain your solution, and you have to play by the book. I mean, I know I was a startup founder myself at some point, and I always had this urge to be innovative in the slides and have, let's say, I mean, certain segments about personal stories, about innovate, about projections, but always try to play by the book. Investors love to see a normal, standardized flow of the slides, starting with the solution, with the problem, then the solution, then the market sizing, then the go-to-market strategy, the business model, and try to have a pitch deck that is less than 20 or 18 pages. The less is more, especially in the first meetings. There will always be time to share your VDR with the investors. So leave the nitty-gritty stuff and the detailed projections and other things into that basket. And leveraging social media is very important, as I mentioned. Let's move to fundraising myths. And there are a lot of myths, to be honest. And every year there's a new trend that needs to be debunked. The first one is fundraising is glamorous. Fundraising is not hard. As a person who was in both ends of the table, I'm going to tell you it's not hard, but it's very tiring and troublesome. It's not about who you meet. It's about how many investors you meet. And it's a marathon. And you don't need to be perfect 100% to start fundraising. That's fine. Investors will know that you're still in early stage. There's a lot of things to be tested in the market, but they want to see some, let's say, commitment and plans in place. And also, there's some tip regarding fundraising. You certainly don't wait once you have 3 months of runway, and then you start thinking about fundraising. Fundraising should be a continuous process. Don't wait till your cash is almost empty, then you start fundraising. And also, it's your job to understand the fundraising process. Don't ever delegate it to anyone else. Some people I see, some founders, they delegate it to many consulting groups or to, let's say, non-managerial members of the team. It's your job to understand everything about fundraising, the milestones, be prepared to answer your tough questions from investors and to negotiate, because this is your company at the end. I need to have a very great network to raise money. So I might be contradicting myself, because in the beginning I mentioned that you need to network and you need to build a long-living relationship with your investors. But it's not a deal breaker if you don't have a network. Most of the companies that we have in our portfolio, the great ones, started with no great network. If you have a product that can sell itself and there's customer demand on it, trust me, investors will find you. But you have to be willing to establish this relationship, but it's not the only thing I should focus on. If investors reject my startup, that means it is bad. I mean, we all human beings, we all hate rejections in any way. I got rejected multiple times in my first venture. Even VCs get rejected from their limited partners. This is how business works. You will get rejected, you will reject others, and you will get rejected, and you will know people who rejected each other. This is how life works, especially in this space. So if you get rejected, don't have tough feelings on the person or investor who rejected you. Keep that investor updated and posted with your milestones, and get back to the investors once you're ready. I mean, some of our startups, we rejected them in the first place, and then we invested them after we've seen improvement in their model and their projections. Funding is synonymous with success. I mean, with fundraising, it's not synonymous with success, to be honest. Because with fundraising, now you have more responsibility to deliver. And if you do not deliver that responsibility, you might get a down round, which will affect you negatively. It's good to celebrate closing a round because it's a tiring, let's say, process. But closing a round, it's not something that you should be aiming for, but should be aiming for achieving the milestones that this round is based upon. And I mean, a healthy way to look at it is, I can put it this way: closing a funding round will give you the fuel needed to reach the big celebration, which is achieving your milestones. So you should be happy, but do not think that by closing the round, it will be okay for you to take 3 months of break to enjoy yourself, because this is where things started to get real. So with that, I'll conclude my session, and I would love to hear your questions.
Yeah, thank you so much, Fahad. And this time is for the question. Let's start with Nabil.
Good afternoon. Thank you, Fahad. Great insights. I'm going to start in reverse. So the fundraising myth, when you said fundraising and success, I don't know if you heard of the story of Airlift, $120 million, and then they shut down. Anyways, I wanted to ask, would you invest in the same vertical or in sort of the same idea in a different location? Pretty much, I'm just going to say this out. Platform and us are quite similar, and we are looking to raise funds. But considering that you've already backed Platform, would you be looking at another business that is the same, that's sort of addressing the same problem?
Very great question, and we get this question a lot during the negotiation phase with our startups. And thank you for raising it. So it's a case by case, to be honest. And let me talk to you about the VC in general. Then I'll talk to you about our case.
Sure.
So normally, when there is a direct competitor of a startup, of an existing portfolio company in your fund, it's better not to invest in it. However, if it's in another region, then it will be, let's say fine to invest in it, but only if you think that there will be no expansion of your existing startup to that region. I'm talking about direct competitors, like identical companies that provide the same solution. However, if we're talking about adjacent companies, let's say in a sector like, let's say, your sector or e-commerce, it's totally normal. And as you saw our breakdown of our sectors, we invest in variety of companies in the same sector. Otherwise, if we don't do that, we will not invest in any company, only one company per sector. And there's only one, and there's also one more thing. It's okay for VCs to invest in direct competitor if the investment was in two separate funds. So if, let's say, there's a VC has a fund called Fund X1, and it invested in your company, and then they closed this fund, and they raised a new fund, which is investment fund X2, they could invest in your competitor, direct competitor. That's legally fine, but normally VCs will not do it because it might arise tensions with their existing partners. And for vision, yeah, we tend to not invest in direct competitors, but sometimes there are multiple investments in our portfolio which have adjacent, let's say, products, but not identical. So thank you.
Great. Thank you
Next
very much.
question. I think we have a question from Haneen SPA.
Yes, hi Mr. Fahad, how are you? كيف حالك؟ كان عندي سؤال. هل أنتم تستثمرون في منصة مثلا direct competitors ولا that's يعني فيها conflict عندكم؟
ممتاز. Same answer to my previous questions. We tend to do it like a case by case, but normally direct competitors is not optimal for VCs. However, if there is two different funds of a VC, if we invested in a company in the first fund and then we invested in the direct competitor in the next fund, that is totally normal. But we have to look at the cases before we do that. And normally there are some VCs who invest in direct competitor in the same fund. But even if it is well, let's say, shown in the VC, let's say, social media or their interaction, and they say that they don't invest in that competitor, I don't think it will hurt if you approach them and you present your opportunity or your company to them. At least you get to know them and they know you. We have a question from Amira.
Yeah, Amira, are you with us?
Are you hear me? Hi. So is the mic is like muted. Thank you so much for the presentation. It was really valuable. So my question is about the sectors. Have you been already invested in agtech sector? As we are already an agtech startup with SaaS model actually. It's not a hardware-based solution. Second, what are the ticket size, the minimum and the maximum for the seed round, for example? And the third question is about can you take a position of like a lead investor, or also you are like you come as a follow-up investor?
Great question. So let me rephrase your questions. You asked about do we invest in edtech? Is that edtech or adtech?
Agritech.
Agritech. Oh, okay.
Yeah.
Great. Got it. And your second question is what's our investment ticket in our seed stage, and what's the other question?
It was about did you take a position of the lead investor? Yeah.
Okay, perfect. So I'll answer the last question first. So our aim is always to lead the investment round, and we have no problem to be co-leading with another investor. We tend usually to invest in our first checks with the startups. We lead their round, and then when they open new rounds in the future, if we see their performance is improving, we will tend to stick with them and lead their next round and lead their other round and lead their other round until they are ready to scale. So that's for leading the round. And for the ticket size for seed stage, so normally depends on the valuation of the company and also how much they are raising. So and also the dynamic of the round. But as I showed you earlier in the presentation, for early stage pre-seed seed, we invest from $250 to $1 million. And more than that, that's for a first check, and it could be upper than that, depending on the situation. For agritech, we have a company called Platform. We invested in way back in the time, I think in 2019, and we believe that agritech is a very great market with huge potential. And I think also that's the case with other VCs. But for us, I mean, we are sector agnostic, as I mentioned, but our most prioritized sectors are the ones that I mentioned in the beginning. But that does not mean we don't invest in other sectors. When we see a commercially viable product in any sector, even if it's not interesting sector, we will invest in it. And I believe agri-tech is one of the most, let's say, promising sectors in the next few years. Thank you.
Thank you.
And question from Abdullah.
السلام عليكم، شكرا لك أخ فهد. فيش الفرق بين الكراود فاندينج والفي سي؟ One, and if a company has had funding from a crowdfunding company, would the VCs still be interested to look at those companies or startups?
Thank you, Abdullah. It's a very important question, and there are many answers to this question, and the answer change based on the timing. Things are not the same as last year in terms of crowdfunding. Crowdfunding now are getting licensed, and there are many, let's say, cases for crowdfunding. But to give you like a general answer, VC normally don't invest in crowdfunded backed startups for a variety of reasons. The first reason is their legal, let's say, structure, because when there's a crowdfunded company, it has to be by law, it has to be a joint stock company. And normally VCs don't invest in such legal structures. We invest in private limited liability companies incorporated outside an offshore, as an offshore entity. That's the first thing. And the second thing, when you do crowdfunding, the cap table will be a little bit messy. And there will be a lot of, let's say, governance regarding that, which will be another problem for the VC. However, we've seen some cases where VCs invested in crowdfunded company before and after, and things change with every year. This year, crowdfunding space is totally different than last year and the year before it. And you could see that, as I mentioned, and there's a lot of times that the VC and the crowdfunded company could, let's say, structure a deal where all of the things that I mentioned could be, let's say, waived or skipped. So there's always a solution if the company is commercially, let's say, viable and interesting to the VC. And you said the differences. The differences, I think you already know the differences between crowdfunding and VC. Crowdfunding, you raise the fund from the public, from multiple investors. Some of them might be accredited investors, some of them are not. And you do it and you take equity from the company if it's a crowdfunding by equity, or you take or done through debt. Where VC, it's just one single entity that invests in a startup, and also there will be, let's say, the VCs could add more value than a crowdfunding company because of their expertise and their network, and they are only one single shareholder in your company. So that's also my answer. And thank you for the question. It's a very great question. I think we have a question from Khalid al-Malki.
Yes, hi, Mr. Fahad. Thank you so much for this informative session. I have two questions actually. Do you take typically like board seats on the startups that you're investing? And my second question, I think you just touched the surface, and I don't know if you have time, but could you maybe go through like the diligence process? So how does it look like for startups? Thank you.
Thank you for your question. Very great questions. My answer for both questions, it depends on the company, their industry, and also the stage. For both the due diligence and also for being involved in the board. Let's take the due diligence, for example. When there's a company that has just launched their MVP, the due diligence will be totally different than a Series B company where there's, let's say, multiple revenue stream and many millions getting injected, and getting generated by the company. So it's two different, let's say, due diligence processes. But let me focus about the early stage, which is, I assume, your case. So normally, what we do as a due diligence, we follow certain, let's say, systematic steps to evaluate the company. First of all, we start by the commercial due diligence, which is the most important thing, and this thing could be done in the beginning of the sessions and the meetings with the startup. And after there's an interest and there's let's say an approval or first approval from the management team to invest in this company, we will start the second part of the negotiation, which might come during or after signing the deal, which is the legal due diligence, the financial due diligence, and also the technical due diligence. The financial due diligence can come before some of it, like evaluating your forecast and projections, evaluating the solidity of your use of proceeds, and in Vision Ventures, because we are our management and our team have that very strong tech background, we tend to do a thorough tech due diligence in the company. And the reason we do tech due diligence is not to just figure out what are the bad things so we don't invest, no, but we want to understand what are your, let's say, areas of weaknesses so we could help you in the future improve, because we do a lot of tech due diligences with companies. There are certain criteria that we follow. And for your second question, which is concerning the governance and board seat, yeah, typically we do take board seats, but that's not always. It also depends on the stage and the company. If we think that we will add value to the company, if we think that we could help them, let's say, establish a clear governance and help them in their journey, and also to protect our interests, we will take a board seat. Like the board seat that we've taken in the company called the Chefs, where we served as the chairman of their company. And at some point of our lives, of the company's journey, if we think that the company became mature, we might leave the board and leave it for the management and other investors to do, later investors to decide. Very great question.
Thank you, Fahad. We have a couple of online chat questions as well from Wasim from Verifax. Does Vision participate in Safe Notes?
Yeah, of course. I mean, Safe Note is the most used, let's say, agreement in the space in Saudi and in the region. We do Safe, we do KISS, and we do equity rounds. And sometimes based on the deal and the stage, sometimes we also have our own convertible loan agreements that fits the deal itself.
Super, thank you. He's also asking, do you have technical DD team, due diligence team?
Yes, of course. I mean, guided by our management team who were also tech-savvy entrepreneurs at some point of their lives. We have also a dedicated technical team to evaluate the company and also to help the company later on in their journey. Also, there are some functions that we outsource if we think that it's better to outsource it, because technical due diligence is a very, let's say, there's no, let's say, one technical due diligence for every company. There's many sectors, many technologies, many emerging technologies that are there, and we might outsource some of our DD. But most of the time, we do it ourselves. And this is, I think, one of the edges of Vision Ventures, because we, as I mentioned, we come from a tech background, and the founders were CTOs in other companies in the past, and they know very well how to code, how to develop, and how to make the needed DD for the company.
Amazing, thank you. Final question, and very importantly, how do all these amazing startups get in touch with Vision Ventures? Is it via your website, or what's the best way?
So we review a very good question, and I touched upon it, but let me explain more how we review and where we get these deal flow from. The main source is our website. We review every single application that gets submitted into our website thoroughly. and our decision or response comes within less than 2 weeks. Also, we get deal flow from interacting with startups like this meeting, for example, and from variety of means. As I mentioned in the meeting, deal flow source is very important, and we have many things to do. But to answer your question shortly, you could apply to our website, through our email, to our social media platforms, or like physically if we ever meet in person.
Super. Thank you so much. Really appreciate that, Fahad. I think I can comfortably speak for everyone saying this was a really, really good presentation. And thank you so much for taking the time and meeting with everyone. Hopefully there'll be a lot of interest, and hopefully you're going to get a lot of applications through the website, etc. You may have some people reaching out to you on LinkedIn as well. You have been warned. So
thank you so much. It was a pleasure. Thank you for making this happen. And looking forward to meet all of you, inshallah, in the future in a physical session where I could learn more about your businesses. And thank you again, Plug and Play, and thank you, MCIT, for this wonderful session. Thank you.
Thank you so much. And hopefully we can get you on site to meet with cohort when they're all going to be there in May. So we'll coordinate with that, Fahad, to hopefully get you guys to meet everyone in person. And thank you so much for your time, and thank you everyone for attending.
Thank you. Thank you.
Thank you, Fahad. Thank you all.
Thank you all.
Thanks, Hans. Thanks, Fahad.
Thank you.